Let's get the bull and bear arguments now to our economy with our chief equity strategist and economist, John Blank. John, there's always two sides to every argument. Let's start with the bear side first.
Yeah, the bear side is that nobody is thinking about a downturn in the stock market that can change the tone of this entire economy. Nobody's thinking about the effects on interest rates that have been jacked up for the last 2.5 years, and that they actually do start restricting growth. So basically, we're not actually considering the tightening the Fed has done as something that could cause a recession anymore, and that's the big problem.
And on the flip side, the bull side.
The bull side is that, basically we are, seeing record highs in all kinds of stock indices that are raising everybody's sentiment and raising everybody's personal wealth. And we aren't seeing any yet, downturns in a tight inventory situation in housing, though there is starting to loosen up. And that basically, with housing and stocks being at record high prices, people who own those things are feeling fine, and the job market's holding up well. So, lot of strength from the job market, and not a lot of evidence that people are worried about housing and stocks crashing yet is keeping everything going.
If we dig a little deeper into the data, what's the upside, or the update rather, on the CPI and inflation? Is inflation really under control?
Well, we got a core PCE rate, Terry, that, both core and broad are in the high 2s, 2.6, 2.8-ish. And that is, within 6 to 8 tenths of a point of the Fed's statutory mandate. And that is the measure that people care about. And we are talking on the 29th of February, just after it came out from the BEA. So it's heading in the right direction. It's moving down, one tick at a time. Well, it'll take us one tick at a time in February. We'll get to 2% here at the end of this year. So the strategy here is that we're at the statutory level the Fed likes by January of 2025.
And how then does consumer sentiment fit into the story?
Well, if prices aren't rising, consumers feel better, and that's been true and recorded by the Consumer Sentiment Index of the University of Michigan, which has come back quite a lot as it keeps on improving, and that is clearly the case, and it's actually boding well for the incumbent president of the United States as well.
But you wrote recently that one signal portending a U.S. recession still lives, the U.S. Treasury yield curve inversion. How long does that yield curve have to persist before it becomes, or that inversion have to persist before it becomes an accurate recession predictor?
Well, Terry, what's interesting about that, I was looking into that, and when you get our yield curve at the length of time we've seen one, it's a situation where it should have come by now. So it's starting to become what's called a false positive, which is it's indicating a recession there really isn't one. And actually, the Conference Board who produces that yield curve, their leading indicators is also saying they no longer expect a recession in 2024. So I think the lesson here is when you have a supply shock like we did, all these leading indicators and all these yield curve inversions that people are referencing are built around cyclical demand management, not supply shocks. So I have to say, you have to be understanding that this is an entirely different macroeconomic event, and therefore, using indicators and structures that are built to forecast demand management when you're in a supply shock makes no sense whatsoever.
Speaking of supply, we don't hear a lot about it anymore, but are there still supply chain pressures on the economy?
I don't think so, Terry, although we're starting to see in the JP Morgan market global manufacturing PMI getting above 50 the first time in 16 months. So going forward, we might actually see some supply chain pressures.
How do you see the labor market, especially going forward?
Well, Terry, at 3.7% on the household employment rate and being below 4 for well over 2 years now, or under 4 for well over 2 years, that is a tight labor market. We're still seeing initial weekly claims, below in the 200 area week to week, and it's proving that people are having a longer interregnum to find a job if they lose a job. It's getting more and more difficult to find a job, but people are still finding them. And by the way, that's what the Fed wants. They are creating that pressure to keep the lid on wage increases that could spiral into more inflation. So got to understand the Fed wants this, and as long as it stays contained and manageable, they will like it.
Is the Fed then still committed to rate cuts this year?
Yeah, I think so. 4 rate cuts is probably what's going to happen starting in June, 3 or 4 based on the data. And that's exactly what the Fed funds rate is saying. It's at 5.33 rate, and the 10-year Treasury is at 4.33 or 4.30. There's your 100 basis points of easing. So you don't need to be going to any more work than look at 10-year at 4.3 and then look at the Fed funds at 5.3 and figure out everybody's looking for 100 basis points.
How does our economic story then compare with the global economic story?
Pretty simple. It's pretty consistent. Record highs in Japan, even though there was a recession there. Record highs in stocks in Europe, even though they're not having great growth rates. And it's the same phenomenon where these major companies that make up the indexes are driving stocks up and are disconnecting the stock markets from the underlying economy. Difference is here we actually have a strong economy, a strong stock market. Probably overvalued here is what the problem is. And then there's not a huge valuation issue in places like Europe. There might start to be a valuation issue with Japan.
All right, Zach's strong buy stocks this time include Coinbase Global, Royal Caribbean Cruises, and Sumitomo Corporation.
Yeah, Coinbase, we got to talk about Coinbase, of course, because the Bitcoin ETFs are causing a lot of buying of Bitcoin, and that's driving the price up. So now you've got Coinbase at $200 a share. It's the number one ranked stock, and like we talked before, I worry about valuations. There's F for valuation here. You have to worry about anything that gets an F for valuation in our system, and this one certainly does. The forward PE ratio, just to give you an idea how crazy this has gotten here, is 200. So it's definitely the case that there can be a massive drawdown in Bitcoin. But then, the underlying catalyst here is the major institutions got approval for Bitcoin ETFs, and they're piling in where there's a fixed supply of Bitcoin. So that's what's driving the price up. The people who wanted Bitcoin to turn around worked hard to get those Bitcoin ETFs approved, and this is proving to be the catalyst. And also, getting new highs out of Bitcoin is consistent with getting new highs out of stocks. So it's definitely a speculative situation right now.
Okay, Royal Caribbean Cruises.
Yeah, so people are definitely going on cruises, Terry. And here's a stock that's $122 a share. Zach's number 2 ranked stock. And here's what's nice. The style scores, A for value, A for growth, and A for momentum. So you have to believe long or short term that Royal Caribbean is going to be here and you're going to make some money on this stock. As long as you don't obviously get a big downturn. They leisure companies like this, people will cut back on the cruises because they're discretionary. But as long as the stock market and the economy holds up and housing prices hold up, RCL is going to move up.
And Sumitomo Corporation.
Sumitomo is a Japanese stock that you probably do not know. It's a holding, one of these old companies, tickers SSUMY. And as we've spoken about, there's a 35-year high in Japanese stocks, but this stock is not one that's participating in. I've got it at a $24 a share price, which is incredibly low, $23 a share. So that gives it, but it has its Zach's number 1 rank with an A for value. So if you think there is going to be within Japan rotation into cheaper stocks that look good, this is one to know about, ticker SSUMY.
Okay, our chief equity strategist and economist, John Blank, on the economy. With John, I'm Terry Ruffalo. Zach's 7 best stocks for the next 30 days is a report that you may want to consider purchasing for just $1. It's a just released special report that names all of these tickers. And again, it can be yours for just $1. Go to Zacks.com/promo for details.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.